Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large-cap growth and also one of the best-performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Brian, I think really the story of the tape for this year especially has been the velocity of the moves that we're seeing, whether it's to the downside or to the upside.
Yeah, absolutely. The volatility has been extreme. Movement has been fast, and so you as an investor, you need to kind of pick your levels, and especially if you're shorter term time frame, and stick to those risk lines that you identify in the charts.
Let's take a look at your first chart here, the Nasdaq-100, and the question that we're asking is there a double bottom forming in the Nasdaq-100, and what's the significance of that?
So I think there is, and I think it's formed. We bottomed initially down about 18% in late February. Actually, the low on February 24th was the day of the invasion. We were down about 18% off the late December highs. We rallied about 1,300 points higher, and then into last Monday of last week, we retested those lows, made it slightly lower lows, like marginally, and now we're rebounding higher. What was, I think, the catalyst for the move up was 2 days later on Wednesday, just a week ago yesterday, when China came out with its declaration that from its financial regulator, it's going to support markets, it's going to support the economy, take measures to do so. The Hang Seng Index was down over 40% just from the February high. The KWEB ETF, which is a common institutional ETF trading Chinese technology stocks, that's down 80% from the high. So, that market, was hit quite a bit. And, along with, we had the Fed interest rate, the Fed FOMC last week. The markets now are rallying higher. We've broken up above the midpoint of that double bottom pattern, and so that projects up to about 15,600, up about 6 to 7% from here. And then you're going to run into some key price levels where we had a prior high from August of 21, and then some lows during the topping process, a support line, prior high, then prior support, common technical price action, but some lows that were developed along November and December of last year. So I think that's the key test going forward from here. Yeah,
and equally interesting is this longer term chart that we have with the 10-year, and we can see the velocity again here of the move. It's not typical to see rates move in that fashion in such a short amount of time.
Yeah, so there's been a secular downtrend in interest rates since the early 1980s. So a price channel clearly defined, very well known throughout the marketplace. We briefly broke down below that lower bound of that price channel when major risk-off events have taken place. In 2016, it was Brexit. Even further back than that, in 2008, it was the global financial crisis. More recently, in 2018, when we had a very bearish risk-off fourth quarter. And then the big breakdown below was COVID, when rates went extremely low, almost negative. So we're now rallying back higher, and we're now piercing the upper bound of that price channel, which has happened a couple of times in the last 10 plus years. But typically when that's happening, the economy is very strong, doing very well, and you have an inflation environment from typically what is strong economic activity. But what's different nowadays is that inflation is really not just because the economy is strong, and it has been strong, even though it is now slowing. But as you know, the supply side concerns related to shutting down the economy, Ukraine.
Yeah, I want to switch gears for a moment here and talk about crypto. We are in a risk-on environment here, and I want to take a look at the chart. In Bitcoin, there were some really interesting developments this week. Of course, Goldman with the big OTC trade that they had placed, and you have BlackRock starting to talk about digital assets more. The real big banks are getting into this space now, more outwardly so. Anyway, and kind of seeing that in the price performance, not only with Bitcoin, but with the space overall for the most part.
Yeah, and keep in mind, Bitcoin, it's had a significant pullback off the highs. I think it peaked around 69,000, and then in January we saw it bottom around 32, 33,000. So obviously, it's cut in half. But as the broader markets made lower lows, the equity markets made lower lows in February, and we tested them in March. Cryptocurrencies, many of them, including Bitcoin, have been now in an uptrend. So I would watch that 200-day moving average in Bitcoin. I think it's around 46,000. I think that's been proving in the last few weeks to be a near-term resistance level. If we get back above there, maybe we could make a run then for the prior highs.
Get some fireworks. All right, Brian. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.